All right. Welcome to the Bitcoin panel of the Freedom and Progress Summit. I'm David, and that's Wallace, and you all know Avik. So my first question is for you, Avik. You titled this panel Bitcoin's Comeback. Why?
I guess I need the microphone. So a couple of reasons. One, I mean, just in terms of the price relative to the U.S. dollar, it has appreciated meaningfully since about a year ago. When we had our conference last year, both of you will remember that was literally the day that FTX blew up. So it was kind of...
I bought my first Bitcoins because of you two the next day, and so drinks are on me tonight.
Well done.
Congratulations, Wallace.
Yeah, so this is not a financial advice session, but that was interesting. So just from a standpoint of, there were a lot of people at that time predicting Bitcoin's demise who really didn't understand that FTX and Bitcoin are two different things. People just sort of lump all of crypto into the same bucket. But to the degree there were speculative investors or traders saying, this FTX blow up is going to take a lot of money out of crypto, which includes Bitcoin, then there was a certain perception of that, and there was, there had been a decrease in the price from before. So part of it's literally the price, but I would say the broader, I think, environment is also very interesting. One piece of it is some of the stuff that Wallace will talk about on the regulatory side, where I think there have been some interesting developments in terms of the way the SEC is treating Bitcoin-related products that I'll let Wallace speak to. But the other piece of it, and then there's actually three things. That's piece number one. Piece number two is that in about 6 months or 5 months' time, there will be another halvening of the mining reward for Bitcoin. And so what that means is that there will be a significant increase in the scarcity or the flow of new issuance of Bitcoin. It'll basically halve. The rate will halve. That's why it's called a halvening. And historically, that has led to a significant appreciation of Bitcoin in the past. So, we don't know past prediction, past performance does not lead to future results, but it's something that a lot of people are looking at as a catalyst for how the market will react. I think it's going to be very interesting I think it could go in a lot of directions from a price standpoint, but I think from a maturation of Bitcoin standpoint, it's very significant because we're really getting close to the end of how many new Bitcoins can be issued. Relative to the ones in circulation, the total 21 million. And to that point, the real point about Bitcoin is that the supply is fixed, unlike the US dollar, as I talked about this morning for those who were in my morning session. And that gets me to my last point, which is that the fiscal situation in the United States has materially worsened in the last 12 months, let alone the last 24 or 36 months. Obviously, as I talked about in my opening remarks this morning, there's been a massive increase in the size of the federal debt and also the size of the quantity of U.S. dollars in circulation, both of which are problems. But we're now at a point where the cost of servicing the interest on the U.S. debt, partly because the debt itself has risen, but also because the interest rates have risen from 0 to now 4.5%, means that the fiscal situation of the United States has really deteriorated. And the original case for Bitcoin, it was just a couple of days ago that it was the 15th anniversary of the publication of the Bitcoin white paper. A big part of the original thesis behind Bitcoin, really the central case for it, was that unlike conventional fiat or government money, Bitcoin's supply can increase. The number of Bitcoins in circulation can slightly increase, but the total number of Bitcoins that will ever be issued is fixed at 21 million, which is not true of the U.S. dollar, which has gone from $5 trillion U.S. dollars 23 years ago to about $22 trillion now. And in a world in which the federal debt continues to increase, as Margaret Thatcher used to say, we eventually run out of other people's money. And that's what's happening. What's happening, as I showed this morning, is that there's not enough money in the rest of the world to lend to the United States. Various calculations about how much money there is in the world or how much wealth there is in the world. It's about $300 trillion. And so as the U.S. debt goes from $32 trillion to $50 trillion to $100 trillion, we get to a point where there's just not enough money out there in the rest of the world to lend to the United States in the form of buying treasury bonds. And at that point, the interest rates, it's a vicious cycle. The interest continues to go up because as the price of the bond, the supply of the bonds goes up, the demand for the bonds goes down, which means the price goes up. The price goes down, of the bonds, which means the interest rates that you have to offer to sell the bonds goes up. So basically, a depreciating bond market means higher interest rates. A weakening bond market means higher interest rates, and higher interest rates means that the amount of money you have to spend servicing the debt goes up. And that's really a vicious cycle. And then how do you fund that? You have to print more dollars to lend money to the United States, which is going to lead more and more people, I would argue, to understand that at least Bitcoin is at least partially a hedge, if not wholly a hedge against that. And that thesis, is not going to go away. It's going to be a permanent feature of our lives unless all of us are successful at turning the battleship around.
Yeah, no, for sure. And it's probably worth, before we move into more of the regulatory stuff, to expand a little bit about what Avik means when he says that this could function on some level as a hedge against like a sovereign debt crisis. Avik is right. When the Bitcoin white paper was published, embedded into the Genesis block, or the first block of its blockchain, was a timestamp of a Times of London article where the headline read, "Chancellor on the brink of second bailout of banks." And so the project's anonymous founder, on day one, linked it to this grand experiment in monetary and fiscal policy that was underway in the wake of the 2008 financial crisis. But I think there's definitely sort of a disconnect for a lot of people, which is, okay, well, sure, that diagnosis or fear about the U.S. and global economy might be true, but what does that have to do with these digital tokens, which presumably are worthless, right? Like, why does this thing on a computer have any value? And I think one of the more helpful mental models for understanding at least why some people think that Bitcoin has value is that in many ways it's similar to gold. So it's often been likened to digital gold. So you compare Bitcoin to gold, what are the similarities? Well, they're durable, they're scarce, you can't really make more of it. It's easily identifiable. You can kind of go down the list. Fidelity has a great report they put out a few months ago kind of making this case that in many ways Bitcoin is similar to gold, except that it can be moved more easily online. And so I think that really is the bet, at least for a lot of the more sophisticated and institutional investors that I know who are allocated to Bitcoin. They don't really see it as something that in 10 years will be, $40,000 or whatever it is now. I mean, they're sort of saying, look, we think that there is a non-zero chance that this becomes a dominant non-sovereign store of value akin to gold. And they're making an asymmetric bet on that outcome. And I think that is sort of a helpful mental model for Bitcoin and its price, right? Because right now the market is $700 billion, about 20 million Bitcoin. So you get a price of 35,000. The market capitalization of gold is about 14 trillion. You divide that by 20 or 21 million, you get a Bitcoin price of $660,000 to $700,000, and then investors right now are looking at a price of $35,000 for Bitcoin, and they're asking themselves, well, is there greater than 5% chance of this reaching the market capitalization of gold? And I think that is how a lot of people look at this. They say, well, okay, if I think that there's a greater than 5% chance of that happening, I'm going to buy a little bit of this. If I think there's a worse than 5% chance, I'm going to sort of stay away. And so I do think that is the kind of meat behind the scenario that Avik is describing, is that this could function as a hedge to these scenarios in the sense of becoming a sort of commodity and outside money that functions like gold but online.
I just add to your thoughts there by just saying I think of it as an insurance policy, particularly because our focus at FREOPP, of course, is people on the bottom half of the economic ladder who aren't able to save a lot. But to the degree they can save, if they can put a portion of their savings, a small portion, in Bitcoin, let's say 5% or 10%, if you're right and it's a 20x from here, and by the way, that if it becomes a 20x, it'll be for bad reasons, in the sense it'll be because there's a fiscal and monetary collapse in the U.S. So that's a situation where lower and middle income Americans will be very vulnerable. So the way we look at this from a social mobility standpoint is the reason to really pay attention to Bitcoin and make sure that it has an opportunity to establish itself is because wealthy people can move their assets overseas. They can do a lot of things to protect themselves from inflation. Lower income people don't. When their price of groceries goes up or the price of their rent goes up, they don't have a lot to fall back on. And so if people who are saving $50, $100 a month are able to put $5 or $10 of that in Bitcoin, that may not seem like a lot, but it can add up to something significant if the worst happens.
If I may, and I'm a lawyer, none of this is legal advice. So what you're describing sounds like what you would typically say is the flight to safety, right? So in 2008, 2009, the stock market crashes, people run into treasuries, the traditional. Throughout the centuries, people run from inflationary environments to gold. Given the inflationary times and given the fiscal realities that Avik's describing here, is Bitcoin behaving in the way that you'd expect? And I don't know the answer to that. I suspect it's not, just from what I've heard in the hallways. And if not, why not, would you say?
Yeah, great question. And this is a question that Bitcoin skeptics do raise all the time. It's like, well, it's not Bitcoin is not an inflation hedge, because if it were an inflation hedge, it would go up when inflation is high and it would go down when inflation is low. And I think the way to understand Bitcoin's dynamic is that it's not an inflation hedge in that way, in this sort of immediate sense of inflation is up this quarter, so I gotta protect myself by having Bitcoin. It's more this long-term insurance against a fiscal and monetary catastrophe than it is a hedge against short-term CPI going up or down.
So it's not a substitute for like the short-term bond market or something like that.
No,
right?
but more like the inflation that would follow like monetary debasement, right? Not sort of a general rise in the cost of goods and services.
I mean, right now, just to give an example of imagine that America 10 years from now or 20 years from now is like the Argentina of today. So in Argentina, I was in Argentina in March. The official exchange rate of the Argentine peso to the US dollar was 200 pesos to the dollar. But if you came to Argentina with crisp $100 bills with the blue line on them so they know they're not fake, you can get 400 Argentine pesos to the dollar for those. And so I went to the best steakhouse in Buenos Aires, a place that in New York City might cost you $500 for a meal. I paid $100 for that meal because I used the blue striped $100 bills. So the exchange rate was 200 on official government rate, 400 in the black market. Today, it's $1,100 on the black market and $600 on the official. So it's now November, so in 8 months, it's gone. Inflation has been over 200 or nearly 200% in Argentina, and so in an environment like that, something like Bitcoin can be useful.
Yeah, and I do want to bring it back now to sort of FTX, because obviously Sam's trial just concluded. He was found guilty on all, 9 charges, I think it was 7. And one of the sort of through lines of all the commentary around the implosion of FTX was that it underscored the need for heightened regulation of crypto. And I think that is sort of true, but sort of for the wrong reason, in the sense that FTX's collapse was really no different than Madoff's or any of the other notable financial frauds that have occurred in U.S. economic history. He may well have just been selling widgets, and in the same sort of structure of fraud that we saw with his crypto empire, we've seen time and time again in the capital markets. That being said, it is clear that the rules of the road for crypto are still being written, and even though the sort of mania of 2021 and these crazy meteoric rise in prices has dwindled down, regulatory scrutiny has certainly not. The Bitcoin crypto stuff is still a sort of big thing that's being talked about by lawmakers. Recently, the national security concerns. There's an article in the Wall Street Journal alleging that Hamas used crypto to raise money for its attack against Israel. Of course, the environmental debates around Bitcoin mining continue to abound. And And of course, there are still debates happening about market structure. There's a bill in the House that has stalled a little bit, but gained a lot of attention and traction. So it's clear that post FTX, lawmakers want to regulate crypto differently. And I know last year, Wallace, you made some predictions on our panel about what the sort of collapse of FTX might engender from a regulatory perspective. And if memory serves, I think many of those predictions turned out to be true, or at least materializing now. Do you want to kind of remind people what you called last year?
And if memory doesn't serve, let's just pretend that all my predictions were correct nonetheless. So I think what I said last year, and I would say the same thing today, is that it's unlikely that Congress will pass blockbuster legislation to regulate the crypto markets in a sort of latter-day version of the Securities Act of 1933 or the Exchange Act of 1934, a check. Congress didn't have for a material portion of the last year, they didn't have a Speaker of the House to pass any legislation. The other thing I would have said is that the SEC will not produce any tremendous, earth-shattering, groundbreaking regulation. Now, that's not for lack of desire to regulate. I have a client, in private practice, of a client, the Committee on Capital Markets Regulation, some of you may have heard of. It's a think tank sort of in Cambridge, Massachusetts that collects statistics regarding the SEC's regulations. The Gensler, Chairman Gensler, current chairman of the SEC, has regulated at a torrid pace that is beyond anything that anyone has ever seen since 1934. It is astonishing. In his first year, we counted something like 50 substantive rulemakings in the course of the first year. That's excluding, and John, you'll know all these things. That's excluding simple rules like Edgar manual updates or changing the filing fees for the 33 Act. We're looking at serious material rulemakings across the board. That has not slackened in the second year. But of those, not one that I can think of materially touches on crypto in the way that you're talking about, the way that would create an environment for crypto both to be regulated appropriately and also to flourish. And I think the point that I would make about FTX is, in the 1920s and 30s, the context in which the SEC was originally created was one in which, just like today, there were bad actors in the stock market, there's bad actors in the debt markets. What the SEC was intended to accomplish, in my view, at its very best, is something like the Bureau of Standards, right? There is a locker somewhere in Colorado under a mountain that says this is the perfect kilogram, or this is the foot against which all other feet shall be measured, right? When the SEC does that, when the SEC says, here's what it means to say my net profits are in these here United States, that's an excellent thing the SEC does. And that's originally what the SEC was for. It's not a merits regulator. It's a disclosure-based regulator. So caveat emptor still applies, but we're going to educate the public. And if you want to speculate on some foolhardy thing, you go knock yourself out, but you're going to have a standard against which to measure that foolhardy thing. What I think is lacking, and this is kind of there's the easy answer to FTX, which is, well, something bad happened. We need to go fix it with regulation. There's a more nuanced and thoughtful way of thinking about it, which is this happened in the absence of sensible SEC regulation. Hester Peirce will make this argument far more eloquent than I will of the SEC. FTX happened in a Bahamian monocule, polycule manner offshore, right? In an environment in which none of the big banks, none of our big financial institutions is allowed to take custody of these assets because SAB 121, we don't need to go into that, makes it virtually impossible for a major institution to take custody of these. It took place offshore for a reason.
Company was founded in or headquartered in Barbados and Antigua, right?
Yeah, I mean, and so there are reasons why we have offshore locations. Sometimes they're very sensible ones. If it's around tax policy or something, there's a reason for that, for tax arbitrage that's built in. But running a major financial institution offshore is a red flag, and it wouldn't have been done there. And I don't know anything about. I don't know if Sam Bankman-Fried from Adam. I don't know much of his company, but one has to imagine that, and one knows when one looks at the Coinbases of the world, the serious companies of the world, they're here. They want to be here. They want to be well regulated here. At least that's what their lobbyists say. And they're not. And that's not it's honestly in the vein of FREOPP, it's not even a left or right thing, because this was no better handled under Jay Clayton's SEC than it has been under Gary Gensler's SEC. And those two administrations differ in many things, but not on this.
Yeah, and another sort of interesting point that raises is this notion that crypto companies are wanting to be regulated. Like a massive sort of through line of all of these crypto regulatory debates are, whether and to what extent, crypto companies or cryptocurrencies generally are securities versus commodities. And, we were chatting about this before the panel that what's wound up happening is, the lobbyists for these crypto firms kind of twisting themselves into knots, trying to make these like metaphysical, arguments about why their project, why their token is a commodity, why it's not a security. And a lot of times those arguments are pretty bad. And I think the reason why is kind of that the regulations that exist once these projects are deemed securities aren't really fit for purpose.
Yeah, it's a death penalty. Effectively. Yeah,
right. And we see that sort of manifest throughout the attempts to regulate like digital assets. Another good example would be Elizabeth Warren's Digital Asset Anti-Money Laundering Act, which has this sort of ostensibly noble purpose of trying to rein in, track, monitor, surveil the extent to which crypto is used for terrorist financing or other illicit purposes. But the devil is sort of in the details, where the statutes that Bitcoin mining companies, for example, would have to comply with are sort of untenable. And what I mean by that is not that executives of these companies would prefer not to comply with these rules, but rather that the fundamental nature of the technology is such that they cannot perform their obligations that are laid out in this bill. And so it winds up being a sort of convoluted and fancy way of delivering a death sentence to these companies in this industry if it's passed. And I think you would probably hold the view that the same is true with some of the securities litigation.
Yeah, I think so. I mean, so the case that everyone talks about constantly is the Howey test, right? The Orange Groves case. We don't need to go into the detail. I think I even summarized that at last year's panel. But the test is a payment of money with horizontal commonality, a joint enterprise, essentially, where there's an expectation in the investor of a return based upon solely upon the efforts of others. Now, the reason it's phrased in this way is that the second prong about horizontal or vertical commonality among multiple people distinguishes this broadly from bank loans, right? The second part of the test, the most important part of the test, is thank you. How about that? The second part of the test, which deals with the efforts solely of others, is really about, does this look like a conventional joint stock corporation? That's how they were thinking about it in 1947. From these tests flow the way we actually regulate securities in the United States. Once you're a security, if you're a conventional investment contract outside the digital assets context, you have a prospectus to issue. That prospectus will have a balance sheet and a P&L in it. It will describe the management of your thing, the risk factors attendant upon the thing you're selling. None of this makes a lick of sense when you're talking about most crypto. The plan of distribution for a stock, which assumes an underwriting entity, some sort of middleman selling on behalf of the issuer to the investing public, doesn't really apply in the case of most crypto distributions. What they're trying to avoid is forcing themselves into this round hole when they're a square peg. And it's understandable that they are, and to your point, they are twisting themselves in the knots because, many times the way the Howey test is worded, these things do sound like securities. 99% of the time when someone brings in something, I say, the conservative position is, yes, that is a security, because it's likely the SEC will take that position.
Can I ask a related question, Wallace, which is, historically, the SEC has been less aggressive in whether or conceding that Bitcoin is not a security. But there was a recent congressional hearing where I think Patrick McHenry asked Gary Gensler. Patrick McHenry is the chairman of the House Financial Services Committee, if I've got this right. He asked Gary Gensler directly, do you think Bitcoin is a security? And Gensler basically gave an evasive non-answer, which is like, okay, so what is the SEC's position on whether Bitcoin is a security or not?
Well, this you have to appeal, and you're failing to do so. If you have to appeal to the hoary principle of which agency does Gary Gensler run at the time he's asked the question. So he obviously formerly ran the CFTC. Joking aside, I think that the actual principle with both Bitcoin and Ethereum, whose properties I'm less competent in than maybe Bitcoin, some of the others. The real distinction here is that two horses left the barn before the SEC caught up. And here and no further is essentially the text of the Bill Hinman speech, the famous one on Ethereum. Virtually everything since, whether it's, Jay Clayton said all these ICOs I see, they're all securities. Gary Gensler obviously has enforced very aggressively against anything that's in this space. I think that's really the issue. There really isn't an obvious answer to why is Bitcoin not a security, but Ripple absolutely is from the perspective of the SEC. It's just hard to draw that distinction, I think.
I mean, Ripple there are these founders who are still around trying to make money off it in a way that Bitcoin doesn't have the same.
But as we know in the Ripple case, that's in the eye of the beholder somewhat, and Judge Torres, in a controversial decision, I will say, this is actually one interesting feature of this, and I was thinking about the Grayscale case today as well. The partisan dynamics of these debates are very peculiar in the United States right now. The Grayscale decision was written by Judge Naomi Rao, a prominent and superb administrative law judge appointed by Donald Trump on the D.C. Circuit. She was joined in that decision by Sri Srinivasan, perhaps the preeminent Obama appointee. And they were joined by the elder statesman of that court, who was Harry Edwards, who was appointed by Jimmy Carter back in the late 1970s. A 3-0 decision against an administrative agency where the Democrats outrank the Republicans on the panel is not something you see every day unless the SEC is litigating, in which case it does happen from time to time. I've seen a 9-0 against the SEC written by Justice Sotomayor, which is not something you see every day in every area. I think what's catching up to the SEC here is its excessive aggressiveness. It has a reputation among independent agencies of playing very fast and loose with the Administrative Procedure Act. It has been hammered constantly for 20 years by the D.C. Circuit in particular for failure to do cost-benefit analysis appropriately, for ignoring comments from the public during the notice and comment rulemaking. And in this case, the SEC has gone further into what is generally used as a pejorative term. I worked for Commissioner Pivovar. We use this in speeches all the time. But we're now very firmly into regulation by enforcement territory, where the APA and the rulemaking process are simply ignored. We're going to do this case law style, one by one. And that's just not a way to make a coherent market.
Which is bad, but I think the desire to do something is quite understandable.
Yes,
I mean,
sure,
because you look at every cryptocurrency that's been created since Bitcoin, and depending on how you actually count that, you'd arrive at a number anywhere between like 9 and 16,000. Pretty much all of them have gone to zero. And depending on your perspective, it can sort of range from, well, these are all sort of just naked Ponzi schemes and frauds, which I sort of take that view. But even more generously, you could say, well, these were lofty, startup ideas that didn't work. And it's okay to start a business and have it fail. I think the conventional wisdom is that 95% of startups fail, but we have rules of the road. We have regulations that, you can't go pitch your startup to everyone on the street and take money for it, because we know that's such an incredibly risky endeavor. And it seems that what crypto did was allow anybody with a smartphone to go gamble on things that empirically have a very, very, very high chance of, causing an investor to lose like all of their money. And so another question for you, Wallace, is, okay, we know that regulation by enforcement is untenable. It's not a good way to foster innovation or stop bad actors. But what do we do about the fact that, anybody can just kind of spin up a blockchain project and effectively steal money from unwitting investors?
Yeah, so I do not have a sort of a Madison compromise on how precisely to regulate the market. I will say that there are a few components of it that I think are necessary. You need to find the analogous provisions of our securities laws and change them so that they apply and make sense in this context. So the Securities Act, and let's just go through them. The Securities Act of 1933, this regulates the distribution of securities and requires that they be accompanied in a public offering or a private offering by certain disclosures. Those disclosures, as I alluded to earlier, don't make sense a lot of the time when it comes to digital asset. Well, we need some kind of disclosure. What do people need to know? You tell me. What do people need to know before they invest in one of these? Well, the white paper is part of that. Understanding how this thing works as a matter of computer science and how is it structured as a matter of economic science is something that would be absolutely necessary to know. Something about the founders of it, something about those who are distributing it. Those are also things we would need to know. Let's move to the 34 Act. The Exchange Act regulates broker-dealers and also exchanges in how they are to conduct their business. What kind of capital do they hold? How do they hold themselves out? How are they registered? What is a broker-dealer in this context? Very often these are being issued directly to the investing public by the issuer without an intermediary. What does that mean? Does that mean the issuer has to take on some of those features of a broker-dealer under our system? You can move on to the Investment Company Act, Investment Advisors Act. These are sort of ancillary, giving advice as to these things. What does that mean? I think fundamentally, most really in the weeds securities lawyers think that the primary problem here is how to deal with the custody issue. FTX was essentially self-custodying the assets. This is a big problem. I mean, this is why we separate custody from investment advisors to deal with the Madoff problem of pilfering your customers' or clients' assets. That's the real thing. How do we get these into the hands? I'm not going to name any because they're all big clients of everybody. But how do we get these into the hands of the big bulge bracket banks is essentially what Wall Street would say. And sure, Wall Street wants more money. They want everything driven their direction. I get it. But they are the well-established, I hesitate to use the word public utilities in this context, but they are the established players that I would trust to hold shares of any stock I hold, any bond I hold. We need to figure out some method to allow them to hold these things. And also, the technologists need to get, they have a part to play in this as well. When you're a securities lawyer and somebody comes in and says, we want to launch this, Ponzi coin. And I say, how do you propose to custody this? And they say, well, we can't because it's a thing in the ether. We can Shamir split, or you can put it on, 2 pieces of paper and put it in 2 safes. 100. That's not going to persuade a securities lawyer at the SEC. That stuff. You need to come up with some technological solution, is my view, to convince the SEC that those customer assets are in place and secure.
Right, and we have seen, both the proliferation of that technology and calls for its use and regulation, namely this notion of proof of reserves, whereby a holder of cryptocurrency, like an exchange, can use cryptography to prove in real time without a trusted third party that they have the assets that they say that they do. And I think there was legislation that was actually introduced recently, sort of requiring these entities like Coinbase, et cetera, to publish a real-time ongoing proof of reserves. So basically, they say we have, 100,000 whatever Bitcoin on our exchange. Well, they have to go input into a sort of an algorithm. Well, here is where those Bitcoin are. Anytime they are moved, that is public. I think there are sort of things in the positive direction there, because notably FTX actually had 0 Bitcoin. They were not even buying it to begin with. They were just taking customers' money and donating it to politicians. But I want to touch on something that you mentioned, Wallace, that you want to see sort of custody of this stuff move toward Wall Street, and it does seem like we are headed in that direction with most analysts viewing an ETF, a spot ETF approval as being imminent. Could you weigh in a little bit about the Grayscale case and whether and to what extent that may have paved the way for a spot ETF finally being approved?
Sure. So I alluded to this earlier in my remarks. I should go into a little bit more detail. So as you may know, in 2022, the SEC approved, the Trading and Markets Division, approved, I think, 2 Bitcoin futures ETFs. So where the underlying asset of the ETF is futures traded on, the Chicago Mercantile Exchange or whatever. Over the years, numerous people have tried to launch ETF, spot Bitcoin ETFs, where the underlying of the ETF is Bitcoin itself. These have been routinely rejected by the SEC on the theory that the Bitcoin market, unlike the futures market, is manipulable and subject to deceptive and fraudulent practices. The argument here is essentially that the CFTC regulates the futures market adequately from the SEC's perspective, subject to something called a surveillance agreement, which is essentially an agreement between the ETF and the relevant exchange to say we are capable of monitoring strange movements in the price that would be indicative of, wash trades or front running the market, things of that nature. Well, Grayscale lined up, took its chance, and was rejected by the SEC, as they probably expected. But then they sued. And they argued that, well, this is meaningless. The SEC just approved 2 futures ETFs. Now they're rejecting a spot ETF. What gives? And they argued that the SEC had acted arbitrarily, capriciously, and not in accordance with law. That's the line from Section 706 that the SEC constantly gets hammered with. And their argument was, look, they're not treating like as like. What's the difference between these 2 assets? They brought evidence that the SEC did not adequately or reasonably respond to in the argument of Grayscale, that the correlation of these 2 asset classes, that is Bitcoins themselves and Bitcoin ETFs, are 99.9999% or something correlated to one another. Ergo, Grayscale said, look, there is no single market to surveil with Bitcoin. They're traded all over the place, but we could surveil the CME market through the surveillance agreement. And since they're so tightly correlated to the point where they're surely causally linked, surely we could rely on the same surveillance agreement. So they sent in a surveillance agreement of the same kind. The court agreed with Grayscale. And as I mentioned, it was a bipartisan holding and what we would call a bench slapping in the law. I mean, they really got hammered in this decision. Now, the outcome of the case, I take it as writ that the entire street believes that this is inevitably going to lead to the approval of a spot ETF. It may well. The holding of the case, the outcome of the case, was to vacate the SEC's rejection order, remand it to the SEC for further proceedings consistent with the court's holding. The SEC then refused or failed to appeal the action. And so now it's still pending. Now there are other, I think as recently as today, I think I saw there's 10 or a dozen pending applications that are out there. One of them, the one that's earliest, I think comes due on January 24th. So a decision from the SEC about at least one of these pending ones shall issue, that's the word, just like a gun law, is shall issue from the SEC before January at some point. But they could, in theory, they could say no and then justify their argument under the APA. And this very panel, which did not hold on the merits that you must approve this, they might win still, the SEC. So as a lawyer, I say, yeah, the jury's still out. As somebody who monitors the news, it does seem that that's what's driving up the Bitcoin prices lately, that people do expect these to issue and that there will be a huge increase in liquidity.
Well, why don't we get closing thoughts from you, Avik, and then take a question or two?
We can just go straight to questions. That's all right.
All right. Hello.
Thank you. My voice carries, but I'll take the mic anyway. Good to. It's a great panel. Good to see everyone. Yeah, I know Wallace. I've been on the. I think this is the first time meeting him in person. I've been on the. Was on a
That's
virtual
right.
regulatory
Moderator
transparency. I've been the regulatory transparency project at the Federalist Society with him, and he had actually moderated me in one of my when I was on a panel. And my question is about, I'm very interested also in, and I think it's a good point about, like with Bitcoin specifically, economic mobility and having something where, you don't have to move your money to another country for inflation. But a lot of this with policy, I'm more worried about what is the limiting principle of the SEC in defining something as a security. Once, because it seems to me they've made a giant leap with crypto, and Clayton has actually said this, that whereas anything that has investment value that people may buy as an investment could be could be defined as a security. I mean, Clayton actually, I wrote a paper actually back in 2019 where I quote Clayton as saying that virtually any instrument that may be sold as an investment. Those were his words in writing to Ted Budd. So people buy a lot of things as investments, including art, comic books, things like that, and those are just right now considered products. But if you were to just stretch the investment to rather than a stock or a bond that gives you a claim on a common enterprise, then and you say anything you buy as that could be bought as an investment is a security, and then subject to SEC regulation, Sarbanes-Oxley, other things. I mean, where does it stop? And does Congress actually need to, or the courts actually need to limit about what is a security? I think Judge Torres tried to do that in the Ripple case. He said, well, a horse or a car could be as an investment, and people will sell a lot of investments, to David's points. I mean, to someone on the street. So my question is, does there need to be any limiting? Is there a danger of that the SEC is stretching its authority over what is a security and could be defined to other products?
Yeah, I mean, there's no question that they're stretching their authority, and I'm often persuaded by their Howey analysis, to be honest. It depends on the case at hand. I think fundamentally, this should be Congress. I mean, Congress has abdicated its role here and in many other places. These products are sufficiently distinct from either a Ted Williams baseball card or a share of Ford Motor Company that they really do need their own statute. And I do think that, to David's point from earlier, it would dramatically reduce the amount of metaphysics and angels dancing on the head of a pin at the outset if the outcome of being labeled a digital asset security, whatever we're going to call it, were less severe than it is now. I think people wouldn't argue on the fringes, and the SEC wouldn't feel this compulsion to expand its authority. Now, the SEC will always have a reason to expand its jurisdiction, as we know, but there would be less of a justification for doing it at the margins if these things could just, as a matter of course, be sold and traded like any other financial product.
I was just going to add that there is a bill that's been introduced in Congress 2 times now, the Responsible Financial Innovation Act from Cynthia Lummis, Senator from Wyoming, and Kirsten Gillibrand from New York, which would do a lot of things that you're describing, right? It would create a standardized disclosure system for crypto tokens that get defined as securities. Basically, you'd have this 2-year kind of window where you wouldn't be regulated, but then after 2 years, you'd have to prove that you're not a security. And if you're not a security, then the CFTC would regulate you. If you were a security, the SEC would regulate you, and there'd be these kind of disclosure instruments. It's not a perfect bill, but it's pretty good. I've written it up for Forbes for people who are interested in looking at it more closely. So that would be the kind of thing that would be an example of what you're talking about. But it's not getting a lot of traction in Congress because either because there's lack of interest or lack of urgency, or because a lot of people who don't like crypto kind of want it to stay in this regulatory limbo.
Yeah. Any other questions? I think we've got time for one more.
I have a political question for Avik. You mentioned that the working class, if they save 10% of their income, they should take the risk and buy cryptocurrency. Is it wise to tell non-sophisticated investors to do something so risky versus just putting that money in the S&P 500?
So just to be very clear, I didn't suggest that people should put their money in crypto. I said specifically Bitcoin. And the reason for that is because, as I said, it's an insurance policy. In a world in which there's a massive fiscal collapse of the United States, the government assistance that people are eligible could collapse. The stock market could collapse. The U.S. dollar's value could collapse in the sense of there's massive inflation. And so obviously 10% may not be the right proportion for some people. It might be more like 5% or 3%. But something that you basically, the way we've often talked about it in the Bitcoin community is put away an amount. We used to say put away an amount of money that you would be comfortable going to zero. Now, Bitcoin is not going to zero. It's been around long enough. It's been around for basically 15 years. In terms of real trading, it's been more like 13 years, 14 years. But it's been around long enough. It's proven itself to be a pretty resilient asset in terms of value. Yes, it goes up and down, but it does not go to zero. Now, there is risk. There's absolutely risk, just as there is in the stock market. Maybe it's you could argue that historically it's been more volatile than the stock market, but not recently. If you look at the volatility of Bitcoin over the last 2 years relative to the volatility of the Standard & Poor's 500, the S&P 500, it's not that different actually. So the volatility is pretty much the same. But really, the point of Bitcoin is that if there's a collapse in the mainstream economy, you may have something to rely on. Now, ideally, in a broader world, we'd have a policy environment where we fix the federal debt, and so we don't put people at risk in that way. But my point is that if we have a Weimar Germany or Argentina-style fiscal and monetary collapse, where do ordinary people protect themselves? And this is a way of at least protecting a small amount of their savings.
All right. Well, that concludes our panel. Thank you. Thank you.